Most people think investing is only for rich people, or finance experts, or people who magically understand money. But here's the truth. Investing is simply the art of planting money today, so it grows into something bigger tomorrow. And if you don't learn how to invest, you pay the price. Slowly, silently, and painfully. Because inflation steals from you, your savings lose value, and your future becomes more uncertain. But the moment you understand what to invest in, how to choose the right options, and how to start, even with little money, your entire financial future changes. So today, we're breaking it all down. Simple and clearly. Let's start with the obvious question most people are embarrassed to ask. What exactly is investing? Well, investing is when you use your money to buy something that has the potential to grow or generate more money in the future. That's it. If you buy a stock, you're buying part of a company hoping it grows. If you buy land, you're buying space that becomes more valuable over time. If you buy a bond, you're giving someone a loan and earning interest. If you put money in a mutual fund, you're joining other investors to buy assets you can't buy alone. Investing is not gambling, and it's not get rich quick. It's the process of making your money work while you sleep. Because if your money isn't working for you, you will work forever. Okay, we're going into each investment option, the benefits, the risks, who it's best for, and how to actually get started. Let's go. Number 1 is stocks. What are stocks? A stock is a tiny piece of ownership in a company. If you own a share of Apple, you literally own a small part of Apple. But how do you make money? 2 ways. First is capital appreciation. The stock price rises. Second is dividends. The company shares part of its profits with you. Okay, why do people invest in stocks? Historically, it is one of the highest return investments. Again, for over 10 to 20 years now, the growth is massive and predictable. And you can start with little money. What are the risks in stocks? Prices go up and down daily. Emotional investors panic and lose money. Requires patience and long-term thinking. Who are stocks good for? Beginners with a long-term mindset. People willing to invest consistently. Anyone who wants to build wealth over decades. How can anyone start? Step by step. Download a brokerage app, depending on country. Start with big, stable companies. MTN, banks, Amazon, Google, Microsoft. Invest small amounts consistently. Avoid day trading. It destroys beginners. Number 2 is bonds. What are bonds? A bond is simply a loan you give to a government, a company. In return, they promise to pay interest regularly, return your money after a fixed period. Why people invest in bonds? More stable than stocks, consistent interest income, great protection during economic downturns. What are the risks in bonds? Lower returns than stocks. Inflation can reduce their value. Companies and governments can default. Rare but possible. Who bonds are good for? People who want stable, low-risk income. Older investors. Anyone building a balanced portfolio. How can anyone start investing in bonds? Buy government bonds through your bank. Use your brokerage or ask your banker. Consider bond ETFs for instant diversification. Number 3 are mutual funds and ETFs. What are they? These are investment buckets that hold many assets inside one package. Stocks, bonds, real estate, and commodities. Instead of picking individual assets, you buy the whole basket. Why they're perfect for beginners? Instant diversification. Your risk is spread. Lower costs to start. It is professionally managed mutual funds. And easy to buy and sell ETFs. The risks? Funds can lose value. Some mutual funds charge high fees. Who they're good for? Everyone, especially beginners. How to start in? Use your brokerage or ask your banker. Just choose a fund. Automate your deposits and grow. Number 4 is real estate. What is real estate investing? It is simply buying land, houses, apartments, or commercial buildings to rent out or sell at higher prices. Why people love real estate? Physical asset you can see. Generates passive rental income. Historically grows over time. Hedge against inflation. The risks in real estate. Requires higher capital. Tenants can be a headache. Properties can stay empty. Maintenance costs. Who it's good for? People with medium to large capital. Anyone looking for passive income. Long-term investors. How to start investing in real estate. Buy small plots of land. Join real estate investment groups. Use fractional real estate platforms. Consider REITs, real estate investment trusts. 5. Cryptocurrency. What is crypto? Digital assets built on blockchain technology. Bitcoin is the most popular, followed by Ethereum and others. Why people invest in crypto? Potential for huge returns. Decentralized, not controlled by governments. Technologically revolutionary. The risks? Extremely volatile. Easy to lose money. Scams everywhere. Requires knowledge. Who it's good for? Experienced investors. People with high risk tolerance. Not beginners putting all their savings. How to start with crypto. Use reputable exchanges or platforms. Invest only what you can afford to lose. Focus on Bitcoin, Ethereum, and emerging coins after your due diligence. Number 6 is private equity. What is private equity? Investing directly in companies that are not listed on the stock exchange. You're basically buying ownership in early stage or growing businesses. Why people invest in private equity? For potentially massive returns. You invest early before the company blows up. You can influence the business growth. The risks? High failure rate. Long investment periods, 5 to 10 years. Might be hard to sell your stake. Who it's good for? High-income investors, entrepreneurs, people who understand business. How to start with private equity. Angel investing groups, venture capital syndicates, equity crowdfunding platforms. How to choose the right investment for you. Choosing is not about what's best. It's about what matches your risk tolerance level, income goals, time horizon, and knowledge. For short-term goals, that is, goals within 1 to 3 years, choose high-yield savings, money market funds, short-term bonds, or real estate, that is, land banking. For medium-term goals, that is, within 3 to 7 years, choose mutual funds, real estate, bond plus stock mix. For long-term goals, 7+ years goals, choose stocks, ETFs, private equity, or real estate. This is how you can start as a beginner using the 80-20 rule. Put 70% of your investments in simple, low-risk options, mutual funds, index funds, and government bonds, and put 30% into higher risk, higher reward, stocks, crypto, private equity. As your risk appetite and goals change, you can alter this ratio to even 30 to 70, depending on what suits you. How to start investing, even if you're broke. You don't need 1 million. You don't even need 100,000. You need discipline and consistency. Step 1, track your spending. Know where your money is going. Step 2, build an emergency fund. 3 to 6 months of expenses. This serves as a cushion for any life emergencies, so you don't go liquidating the new investment you're about to begin. Step 3, choose one investment vehicle or option. Don't overthink. Step 4, automate deposits. Even 10,000 Naira consistently grows. Step 5, stay invested. Don't panic sell. Don't chase hype. Don't compare your progress to others. Investing is a marathon, not a sprint. If you understand these investment options, if you choose the ones that fit your goals, and if you start today, even small, your future will look completely different. You'll have more freedom, more security, more options, more opportunities, and more peace of mind, because money stops being your enemy and becomes your ally. If you're not yet subscribed, you might not hear from us again. YouTube doesn't always show our videos. So hit that subscribe button so you don't miss more world-class lessons on money, investing, and financial transformation. Your future self will thank you.